Usually, when we look at a company's financial health, there's this baseline expectation of precision. It feels like engineering.
Right, like it's a math problem.
Exactly. You pull up the quarterly report for like a major software as a service company, and you can see exactly how many monthly subscriptions they sold.
Yeah, the churn rate, the customer acquisition costs, it's all right there.
Right. You track the server costs, the marketing spend, and the analyst just points at a cell on a spreadsheet and says, there it is. That is the profit down to the penny.
Which is very comforting. It's binary.
Yeah, it's totally binary. You either sold the widget or you didn't. And as investors, we find that comforting. We like things to be visible, perfectly categorized in real time.
But then you step into the world of property and casualty insurance.
Oh, man. Yeah. And suddenly that precision instrument just shatters.
Completely shatters. Because you're no longer looking at a closed loop.
Right. We are looking at a financial landscape that is built entirely on estimating the future and, sometimes even more terrifyingly, estimating the past.
Yeah, that murky, probabilistic reality. That's exactly what we're dealing with today.
It is. And that is exactly what we're digging into as we look at the Hartford Insurance Group's Q2 2026 data. So welcome to this deep dive under our Talk Tickers banner.
Glad to be here.
If you are a retail investor listening right now, this is your mission control. We have a massive stack of data in front of us.
It's a very dense stack of data.
Oh, incredibly dense. We've got the official earnings transcript, the Q&A session, and the management commentary for ticker symbol HIG. And our goal today is to translate all of this into plain, actionable language.
Right, and figure out if this stock actually deserves a place in your portfolio. Because the insurance sector is, well, it's notoriously opaque.
Oh, definitely. Almost by design, right?
Sometimes it feels that way. Executives throw around terms like adverse development and long-tail casualty.
Yeah, social inflation is the big one right now.
Exactly. It can feel like a deliberate barrier to entry for the average retail investor. Like Wall Street jargon meant to keep you out.
But today, we are going to extract the actual actionable signals from all that noise. Specifically, we need to focus on how Hartford is balancing some, honestly, incredibly aggressive, shareholder-friendly capital returns with underlying loss trends that require some deep unpacking.
There's definitely a lot of friction under the surface there.
So let's take the company's temperature right now. We need to establish the baseline of what actually happened in the second quarter before we can diagnose the long-term health.
Makes sense. Where do you want to start?
I want to start with the top-line data, the headline numbers that hit the wires right at the opening bell, because they're big.
They really are.
Core earnings came in at a massive $945 million for the quarter, which breaks down to $3.42 per diluted share.
That's a very solid beat.
Yeah, but the standout metric, the one that really warrants a closer look, I think, is their trailing 12-month core earnings return on equity, the ROE.
Oh, yeah, that's the number.
Sits at 18.7%.
Which is just wild for this sector.
Right. And their book value per share, excluding AOCI, is up to $78.91. That is a 15% increase year over year.
A massive compounding signal.
So let's tackle that 18.7% ROE first. Because for someone looking at standard blue chip stocks, maybe they don't get how crazy that is. Can you contextualize that number?
Yeah, absolutely. So to appreciate a nearly 19% return on equity in the property and casualty space,
Right.
you have to look at historical industry averages, right?
Right.
Like a very healthy, well-run regional bank or a standard financial institution might be, they'd be thrilled to consistently post a 12 to 14% ROE.
Yeah, 14 would be a great year.
Exactly. And historically, standard property and casualty insurers, they've often hovered in that 10 to 12% range.
Okay.
So hitting 18.7% puts Hartford in elite territory. Truly elite.
Because ROE is fundamentally a measure of management's efficiency, right? It's just the net income divided by the shareholder's equity.
Exactly. It shows how effectively the executive team is taking the equity that belongs to you, the shareholder, and turning it into pure profit.
Right.
When a company operates at nearly a 19% ROE, they are squeezing an extraordinary amount of value out of their existing capital base.
Yeah.
They aren't just sitting on cash,
They're deploying it.
Yeah, deploying it into underwriting and investments with severe discipline.
Okay, so let's talk about the second metric. That book value per share hitting $78.91, that 15% jump. Because book value is essentially the theoretical liquidation value of the company, right?
Yeah, theoretically speaking.
Like if Hartford stopped doing business today, Paid off every single debt, settled every outstanding insurance claim, and just handed whatever cash was left over to the shareholders.
That is roughly what each share would be worth.
Right. Seeing that underlying net worth grow by 15% in a single year, that's a massive compounding wealth signal. But the caveat here is crucial. That number specifically excludes AOCI.
Ah, yes. Accumulated other comprehensive income.
Right.
This is a metric that trips up a lot of retail investors when they look at insurance balance sheets.
It really does. But I think I can break down the mechanics of this because it essentially just comes down to basic bond math.
Go for it.
So insurance companies hold massive portfolios of bonds, right? Let's say I buy a 10-year treasury bond that yields 2%. A year later, the Federal Reserve raises interest rates, and now new bonds are paying 5%.
Right, so your 2% bond looks pretty bad.
Exactly. Suddenly, nobody wants to buy my 2% bond on the open market, so its market value drops. If I look at my brokerage account, it shows a loss.
A big red number.
Right. But I have zero intention of selling it. I'm going to hold it to maturity, get my full principal back, and just collect my 2% along the way. So it is strictly a paper loss.
Yep, completely unrealized.
So by excluding AOCI from the book value, Hartford is essentially saying, hey, don't judge our operating business by the temporary paper fluctuations of our bond portfolio caused by the Federal Reserve.
That is a perfect translation.
Yeah.
I mean, if you include AOCI, an insurance company's book value just swings wildly every time the Fed chair gives a speech.
Which is useless for analyzing the actual business.
Exactly. By stripping it out, we see the true fundamental operating growth of the insurance business itself.
Yeah.
And that operating growth, it's being driven by the industry's ultimate holy grail metric.
The combined ratio.
The combined ratio.
If you want to understand insurance, you absolutely have to understand this one number.
It is the purest distillation of an insurer's underwriting health. The combined ratio just adds together two things.
Okay.
The loss ratio, which is the money paid out in claims.
Right.
And the expense ratio, which is the cost of running the business.
Mm-hmm.
You know, salaries, marketing, broker commissions, all of that.
And it's expressed as a percentage of the premiums they take in. So if the combined ratio is exactly 100, the insurer broke completely, even on the insurance part of the business.
Right.
For every dollar they collected in premiums, they paid exactly $1 out in claims and expenses.
And if it's 105, they lost 5 cents on every dollar.
Not great.
No, not great at all. But if the combined ratio is under 100, they are generating an underwriting profit before they even invest a single dime of the premium money.
Which is the goal.
Always. And Hartford's core engine, their business insurance segment, posted an 89.3 underlying combined ratio this quarter.
Wow. So for every dollar they take in from commercial businesses, they're only paying out roughly 89.3 cents.
Yep.
They're pocketing nearly 11 cents of pure operating profit on every single dollar of premium. I mean, in the commercial insurance space, a sub-90 combined ratio is just a fortress-level metric.
It's massive.
So looking at these headline numbers, you know, a massive ROE, a 15% jump in book value, and a combined ratio in the high 80s, the initial impression is that Hartford is basically printing money in the basement.
They're certainly doing very well.
It looks like a flawless quarter. But aggregate data can be incredibly deceptive, right?
Oh, completely. The aggregate number is like looking at the average temperature of a house and declaring it a comfortable 70 degrees.
Right.
But completely ignoring the fact that the kitchen is on fire and the living room is freezing.
That is a great way to put it.
The overarching data point masks the internal friction. To understand the true health and the actual trajectory of Hartford, we really have to open up the hood.
Right, and examine the three distinct engines driving this vehicle. You've got business insurance, investments, and the highly problematic personal lines division.
Yeah, that's where things get complicated.
So let's get into the story behind the numbers. The good, the bad, and the lawyers. Let's start with the star player, the absolute unit of the quarter.
Small commercial business insurance.
Yes. Small commercial.
Right.
The numbers here are just wild. We are looking at written premium growth of 7% paired with a staggering 86.5 combined ratio.
It's almost unheard of.
Right. That means on policies for small businesses, the local bakeries, the plumbing contractors, the regional tech startups, they are making a 13.5% pure underwriting profit.
Achieving growth and elite profitability simultaneously is incredibly difficult in the insurance market. Usually those two forces fight against each other.
How so?
Well, if an insurer wants to grow fast, they typically have to lower their prices to win market share.
Right, to beat the competition.
Exactly. But doing that inherently damages their combined ratio because they're taking in less premium for the same risk.
Makes sense.
Conversely, if they want a pristine combined ratio, they have to be hyper-selective about the risks they take and raise prices, which of course inherently slows down their growth.
So doing both at the same time indicates what? A structural advantage.
Yes, a systemic competitive advantage.
So what is their secret sauce? Why is Hartford dominating the small business space so thoroughly right now?
Management, specifically CEO Chris Swift and the head of commercial lines, Mo, detailed this extensively on the call. It comes down to a relentless focus on technology.
Okay.
And the resulting strength of their broker relationships. Hartford has invested heavily in automation, data analytics, and digital portal services.
Right, but we hear the word automation thrown around on every single corporate earnings call. It is like the buzzword of the decade.
Very true.
So let's ground this in reality. What does automation actually mean when it comes to selling an insurance policy to a local plumbing contractor?
Okay, let's look at it through the lens of the independent insurance broker.
Sure.
A retail broker's most valuable asset is time. They're trying to secure liability and property coverage for that plumbing contractor. The old way of doing this involved filling out 50-page PDF applications.
Oh, brutal.
Yeah, emailing them to an underwriter at a legacy carrier, waiting 3 to 5 days for a manual quote, going back and forth on terms and conditions, and finally, maybe a week later, getting the policy issued.
A completely manual, friction-heavy process.
Exactly. The new way, the Hartford way, is radically different. That same broker logs into Hartford's digital portal, punches in a few key data points about the plumbing business.
Like revenue, payroll, location.
Exactly. Loss history, all of that. And Hartford's back-end analytics instantly access third-party data to verify the risk. The system then spits out an accurate, binding quote in a matter of seconds.
So it is essentially the Amazon one-click checkout experience, but applied to commercial insurance underwriting.
That's a perfect comparison. When you make the transaction that frictionless for the broker, you win the business. Brokers naturally route their flow to the carrier that makes their job easiest and fastest.
Right, they want to close the deal and move on.
Precisely. During the Q&A, Mo highlighted that the submission flow for their small business team remains exceptionally strong. They hosted a summit with their VIP brokers in May, and the feedback centered entirely on this differentiated, tech-driven user experience.
And I imagine because the quoting process is automated, Hartford's internal expense ratio on these policies stays incredibly low.
Absolutely. They don't need an army of human underwriters reviewing routine small business applications. That low operational cost is a major driver of that beautiful 86.5 combined ratio.
But the underwriting profit is really only half the story of an insurance company. We have to talk about the second engine.
The investment.
The investments. This is a concept that I think a lot of retail investors outside of the finance industry don't fully grasp. Insurance companies are, in many ways, massive investment funds that just use insurance policies as a way to gather capital.
Yeah, this is the exact blueprint Warren Buffett used to build Berkshire Hathaway. It revolves around the concept of float.
Let me break down the mechanics of float, just so we're all on the same page. When you pay your auto insurance premium, or when a business pays its liability premium, the insurance company collects that cash on day one.
Right into their bank account.
Right. But they might not have to pay out a claim on that policy for 6 months, a year, or in some cases 5 years down the line. In the interim period, they get to hold your money. That pool of collected but unpaid premium is the float. And the insurance company doesn't just put that cash in a checking account, they invest it. They get to keep all the returns generated by investing someone else's money.
It's a brilliant business model. And Hartford's investment portfolio is acting as a massive earnings multiplier right now. Their net investment income, or NII, hit $800 million for the quarter.
$800 million in a single quarter?
Yeah.
Generated entirely from the float and their surplus capital. That is up 22% year over year.
It's a huge jump.
So where exactly is that yield coming from? Because, insurance regulators are notoriously strict. It's not like Hartford is taking billions of dollars of policyholder money and day trading meme stocks or speculating on crypto.
No, definitely not. The vast majority of their portfolio is highly regulated and parked in safe, investment-grade, fixed-income securities. We are talking about corporate bonds, municipal bonds, and U.S. Treasuries. Because global interest rates have remained elevated over the last couple of years, the yield on that boring, predictable bond portfolio has steadily climbed as they reinvest maturing bonds at higher rates.
Right, taking advantage of the macro environment.
Exactly. The annualized portfolio yield before tax was a very solid 4.7%.
But 4.7% on fixed income doesn't entirely explain an $800 million quarter. They have an alternative asset sleeve, don't they?
You do. And Chief Financial Officer Beth Costello spent significant time highlighting it. She pointed to their limited partnerships, or LPs, which generated a 7.6% annualized return in the quarter.
Okay, so what is sitting inside those LPs? What are they funding?
It's a diversified mix of private market investments. She specifically called out multiple real estate joint venture sales.
Meaning they successfully exited some commercial or residential developments they had helped finance?
Yes, alongside strong performance from infrastructure and energy transition funds.
Energy transition. Interesting. So we're talking about utility-scale solar farms, grid modernization, wind infrastructure.
Yes, exactly.
Projects that require massive upfront capital outlays, but yield very steady, predictable returns over decades.
Right.
That actually makes perfect sense. The long-term nature of an infrastructure project perfectly matches the long-term liabilities of an insurance company's casualty claims. They are duration matching their assets to their liabilities while clipping a 7.6% yield.
It's very smart asset liability management. So between the fortress, that is the tech-enabled small commercial underwriting, and the absolute cash machine of the investment portfolio, the foundational narrative of the company is incredibly robust.
It is, but this is where the earnings call gets really interesting. And by interesting, I mean this is where the warning lights started blinking on the dashboard.
Yes.
The turbulence.
We have to talk about the turbulence that surfaced during the Q&A session, because Wall Street analysts do not dial into these calls to congratulate the C-suite on a strong quarter. No, they definitely do not. They are probing for weakness.
They are paid to find the cracks in the armor. And the tension on this call centered heavily around a phrase we touched on earlier, loss reserve development.
Yep.
Specifically, Hartford announced they had to increase their reserves for general liability by $46 million and for commercial auto by $26 million.
Right.
I want to spend some time on this because, to a layman, increasing reserves sounds like a responsible financial decision.
It sounds prudent.
Right. It sounds like putting extra money into a rainy day fund. But on Wall Street, this is classified as adverse development, and it is considered a cardinal sin.
It really is. This brings us back to the murky, probabilistic nature of insurance accounting.
Yeah. It reminds me of a situation a few years ago when I set aside $5,000 for a kitchen renovation. I had the budget perfectly planned out.
Okay.
We open up the drywall, and we immediately find black mold behind the sink.
Oh.
Yeah. The contractor looks at me and says, "This isn't a $5,000 job anymore. It's going to cost $7,000. I didn't have a choice. I had to pull that extra $2,000 out of my current paycheck to pay for a problem that was technically created years ago by a leaky pipe.
Right.
I budgeted for one reality, and the universe handed me a much more expensive one."
That is the perfect analogy for adverse development.
Thank you.
When an insurance company writes a batch of commercial auto policies in, let's say, 2018, they use their actuaries and historical data to estimate how much those 2018 policies will ultimately cost in claims.
They make their best guess.
Right. They record that estimate as a liability on their balance sheet, known as a reserve. The profit they report to Wall Street in 2018 is mathematically based on that specific estimate.
But if their estimate was wrong?
If they were wrong, and the claims from 2018 take years to settle and turn out to be significantly more expensive than they initially thought, they have to take money out of today's earnings to pay for yesterday's miscalculations.
To fix the mold.
To fix the mold. That is adverse development. It effectively means the earnings they reported back in 2018 were an illusion. They were overstated.
And the market absolutely hates illusions. It shatters the trust in the accounting.
Completely.
So the analysts on the call, specifically Andrew Kligerman from TD Cowen, zoned right in on this dynamic. He pointed out the $46 million bump in general liability and the $26 million bump in commercial auto. And his underlying question was essentially, is this a one-time true-up because you found a little bit of mold, or is the entire foundation of the house rotting?
Which is the existential question facing every single casualty insurer in the market today.
Right. So let's dig into the why. The actuaries building these models are brilliant mathematicians. They have supercomputers and decades of loss data. Why did claims from 2017 to 2019 in general liability and claims from 2023 and 2024 in commercial auto suddenly get exponentially more expensive when they were finally settled in 2026?
The answer boils down to two words that send shivers down the spine of every insurance executive.
Go on.
Social inflation.
Social inflation. We hear this term everywhere in financial media now. Let's demystify it. What does social inflation actually look like on the ground?
Well, CFO Beth Costello laid out the mechanics very clearly. For general liability, she cited a higher frequency of large losses in the excess casualty and umbrella lines.
Okay.
But for commercial auto, she specifically called out increasing attorney representation.
It is the lawyers.
It is entirely the lawyers. It's a fundamental shift in the legal landscape.
Let's look at how the mechanics of this operate in the real world. Because like a decade ago, if a commercial delivery truck rear-ended a commuter and the driver sustained minor injuries, whiplash, a sore back, the insurance adjuster would typically negotiate directly with the victim.
Right.
They would cover the medical bills, offer a few $1,000s for pain and suffering, and close the claim quickly for, let's say, $15,000.
It was a simple, fast, and highly predictable process.
Yeah.
Actuaries could model that all day long.
Right. But predictability is the key word there.
Exactly. Because today, that exact same accident happens. But before the victim even speaks to the insurance company, they see a billboard or a targeted social media ad from a massive personal injury law firm.
Oh, those ads are everywhere.
Everywhere. And the firm gets involved immediately. The victim is no longer negotiating. They are being directed.
Right.
The law firm sends the victim to specific chiropractors, MRI facilities, and pain management clinics that they have relationships with. The medical bill, the total documented cost of the injury is intentionally inflated.
Wow.
And then the lawyer demands a massive settlement from the insurance company, often threatening to take the case to a jury trial if their demands aren't met.
And the insurance companies are terrified of juries right now.
They have to be. There is a broad, undeniable societal distrust of large corporations. Juries are increasingly angry, and plaintiffs' attorneys know exactly how to tap into that anger.
They're securing what the industry calls nuclear verdicts.
Yes, nuclear verdicts. Judgments exceeding $10 million, even for relatively moderate injuries that would have settled for 5 figures a decade ago.
That's insane.
So, to avoid the catastrophic risk of a nuclear verdict at trial, the insurance company settles the claim out of court. But instead of the historical $15,000, they are forced to pay $85,000.
And when you multiply that dynamic across thousands and thousands of commercial auto claims nationwide, you don't just have a bad quarter, you have a systemic crisis.
That is the essence of social inflation. The cost of claims is rising exponentially faster than underlying economic inflation, solely because of the legal environment.
And we have to mention the accelerant pouring gasoline on this fire, third-party litigation finance.
Yes.
This is a wild concept. Wall Street hedge funds are literally investing in lawsuits.
It has become a fully established asset class. Private equity and hedge funds provide upfront capital to plaintiffs' law firms. This allows the lawyers to reject early settlement offers and drag cases out for years.
Because they know they have the financial backing to outlast the insurance company.
Exactly. They force higher settlements because they aren't constrained by cash flow anymore.
See, this is where I have to push back on Hartford's narrative.
Okay, let's hear it.
If lawyers are increasingly involved, if juries are consistently angry, and if multi-billion-dollar hedge funds are funding the litigation, isn't this a permanent, chronic problem?
It certainly looks that way.
Right. It's not like the personal injury firms are going to wake up tomorrow and say, you know what, we've made enough money this year, let's go easy on the insurers.
Yeah, that's not going to happen.
This seems like a structural, permanent change to the risk landscape that will keep eating away at Hartford's profits quarter after quarter.
Your skepticism is entirely valid. And it is the precise reason why property and casualty stocks often trade at a discount compared to pure technology companies.
The market hates the risk of the unknown tail.
Exactly. But Hartford's management offered a very strong, multi-layered defense to this bare thesis during the call.
All right, let's hear the defense. How did Chris Swift and Beth Costello attempt to calm the analysts down?
First, they provided necessary context on the sheer scale of the balance sheet. Beth pointed out that the $46 million general liability bump, while frustrating, is a very modest increase when you compare it to their total reserve base for that specific line of business.
Which is how big?
It sits at nearly $6.5 billion.
Oh, okay. So it is a fractional adjustment in the grand scheme of things, a tweak to the model, not a complete overhaul of the foundation.
Right. Second, they highlighted the offsets. Yes, they had to add $72 million in combined reserves for auto and general liability, but they experienced massive favorable development in their workers' compensation line.
Favorable development.
To the tune of $110 million.
Okay, so the exact opposite of the kitchen renovation scenario.
Exactly.
They originally estimated that historical workers' comp claims were going to be expensive, and they actually turned out to be incredibly cheap to settle.
Precisely. They over-reserved in the past, and now they get to release that excess money back into today's earnings.
Which raises an obvious question. Why is workers' compensation performing so beautifully while commercial auto is a complete disaster zone?
Well, workers' comp has been the golden goose of the P&C industry for nearly a decade. First, workplaces have genuinely become safer over time due to better protocols and automation.
Okay.
Second, medical inflation regarding the specific fee schedules set by states for workplace injuries has been relatively well controlled compared to the broader healthcare market.
That makes sense.
But the most crucial difference lies in the legal framework. Workers' comp is a statutory coverage.
Meaning the benefits are defined and capped by state law.
Exactly. The system was explicitly designed to be a no-fault, schedule-based compromise between employers and employees. It is exceedingly difficult for a plaintiff's attorney to take a standard workers' comp claim to a jury and secure a $10 million nuclear verdict for pain and suffering.
Because the legal statutes cap the payouts based on the specific injury.
Right. The legal manipulation that runs rampant in commercial auto simply cannot gain traction in the rigid structure of workers' comp.
Okay. So the massive profits from the predictable statutory workers' comp system are essentially subsidizing the pain caused by the lawyers in commercial auto.
Essentially, yes.
But Chris Swift made another vital point during the Q&A regarding the future. An analyst, Mike Zaremski from BMO, asked the million-dollar question. Does this adverse development from 2018 and 2019 change your view on the forward loss trend?
Right.
Basically, do you need to aggressively hike prices right now because your projections for 2027 are suddenly worse?
And Swift's answer was definitive. He stated that the impact on their forward view is measured in tenths of basis points.
So statistically insignificant.
Completely. They feel that the aggressive price increases they have already been pushing through the market, specifically in auto and general liability over the last few years, are fully staying ahead of the loss trends.
Their argument is essentially, yes, the claims from 2018 were worse than we initially modeled, but we are charging so much more for those exact same policies in 2026 that we have already priced the lawyer-driven inflation into our current models.
Exactly. And the data supports their confidence. They are currently securing nearly 10% rate increases in general liability and low double-digit rate increases in their excess and umbrella lines.
Wow.
They firmly believe that level of compounding rate is more than enough to cover the rising cost of social inflation.
I can accept that argument for the commercial side of the house. Business owners ultimately have to swallow those higher premiums. They don't have a choice if they want to operate.
Right.
But that brings us to the third engine of the Hartford machine. And this engine is visibly sputtering.
Yeah, we have to address the struggle in personal lines.
Personal insurance. This is the auto and homeowners policies sold to everyday consumers. You and me. The written premiums here actually declined 7% in the quarter, and personal auto specifically fell off a cliff, down 10%. That is a massive drop in top-line revenue for a major business segment.
A tough market.
What is driving this contraction?
It is an intensely competitive, heavily regulated environment that is facing severe inflationary pressures. Let's start with the pricing actions. Beth Costello noted that renewal written pricing increases were 5.5% in auto and 10.4% in home.
10.4%. They are jacking up the rates on everyday drivers and homeowners by double digits in some cases.
They have absolutely no choice. Look at the underlying costs. The cost of repairing modern cars has skyrocketed.
I mean, that's true.
A minor fender bender 10 years ago meant replacing a piece of plastic and some paint. Today, a bumper is packed with LiDAR sensors, backup cameras, and advanced driver assistance systems.
A low-speed collision now requires thousands of dollars in proprietary sensor calibration.
Exactly. And on the home side, the cost of building materials and labor has surged, combined with an increased frequency of severe convective storms and secondary weather events battering their property portfolio.
So to maintain their target profitability, and to their credit, they did hit a strong 86.3 combined ratio in personal lines this quarter. They are forced to raise prices aggressively to match those costs.
But the consumer is finally pushing back.
Right. When you raise a family's auto policy premium by 10% in a single year, that family goes shopping.
Because the switching costs in personal insurance are virtually non-existent. A consumer can go online, spend 15 minutes on a comparison site, and find a cheaper quote from a competitor with a massive advertising budget.
Competition is cutthroat, and Hartford is losing ground, specifically in their direct-to-consumer channel.
Right. Hartford has a massive historic relationship with AARP for direct-to-consumer sales, which has been a cornerstone of their personal lines business. But they are currently struggling to acquire new customers and retain existing ones in that channel at the elevated prices they need to charge to remain profitable.
Interestingly, though, they are seeing some growth in their agency channel, up 7%, where independent agents are selling their products, particularly a new contemporary product offering that they are slowly rolling out state by state.
Yeah, that's a bright spot.
But the overarching narrative is that the personal lines business is shrinking. It feels like management is caught in an impossible dilemma.
They are.
If they lower prices to win back market share, they ruin their combined ratio and start losing money on every policy. If they keep prices high to protect their margins, they hemorrhage customers to competitors who might be willing to operate at a loss just to gain market share.
It is a classic margin versus volume trap. And understanding this dynamic perfectly sets up the next crucial part of our analysis: management guidance. Because if the commercial business is printing cash, but facing long-term legal headwinds, and the personal business is intentionally shrinking to survive,
how does management plan to steer the ship forward?
Exactly.
This takes us directly to their capital strategy, the future and the capital canon. I want to spend a significant amount of time on the most actionable, fundamentally explosive news for retail investors from this entire earnings call.
The Wellington deal and the mega buyback.
Yes. Let's set the stage with the Wellington transaction. Early in the call, Chris Swift casually mentions that Hartford signed a definitive agreement to sell Hartford funds to Wellington Management.
Right.
Before we get into the financial impact, let's unpack the business logic. Hartford Funds is their asset management business. We are talking about mutual funds and ETFs.
Yep.
Why does an insurance company own a retail mutual fund business in the first place, and why are they choosing to abandon it now?
The history here is actually fascinating. Decades ago, many large life and property casualty insurers decided to build or buy asset management arms. It made logical sense at the time.
How so?
These insurers already possessed massive pools of capital from their float, which meant they had already built the internal infrastructure, the trading desks, and the portfolio management teams to invest that money.
Ah, so they already had the expertise in-house.
Exactly. So the executive thought process was, we have these brilliant portfolio managers picking bonds and equities for our own balance sheet. Why not package this expertise into mutual funds, sell them to retail investors, and collect a 1% management fee?
It sounds like a perfect synergy on paper. It's viewed as a brilliant way to diversify revenue away from the volatile insurance cycle and generate steady, predictable fee income.
It was. But then the entire asset management industry underwent a tectonic shift over the last 15 years. It has become a brutal margin-crushing game of absolute scale.
Because of Vanguard and BlackRock.
Exactly. You have indexing giants dominated the landscape with passive ETFs that charge virtually zero fees. Active management, where a human portfolio manager actually tries to pick winning stocks, which is primarily what Hartford Funds does, has been bleeding assets continuously.
Investors simply refuse to pay high fees for active management that frequently underperforms the S&P 500.
So to survive in modern asset management, you either need to offer rock-bottom fees on passive indexes, which requires trillions in assets to make a profit, or you need a massive global distribution network to keep selling your active funds.
And Hartford realized they simply lacked the scale to compete in that new reality. They were a mid-tier player in a game dominated by behemoths.
Right. Chris Swift framed the decision as strategically monetizing a non-core asset. And the buyer, Wellington Management, makes perfect sense. Hartford has had a 40-year relationship with Wellington.
Okay.
In fact, Wellington already acts as the sub-advisor for a massive portion of Hartford's funds.
Let's explain sub-advising, because this is a dirty little secret of the mutual fund industry. When I buy a Hartford fund, the person actually picking the stocks often doesn't even work for Hartford.
That is correct. Hartford acts as the sponsor and the distributor. They put their brand name on the fund, they handle the marketing, the legal compliance, and the sales network.
But they outsource the actual day-to-day trading.
To a sub-advisor, which in many cases was Wellington. By selling the entire business to Wellington, Hartford is essentially handing over the distribution wrapper to the people who are already managing the money.
Oh, wow.
It puts the asset management business in the hands of a pure-play global asset manager that actually has the scale to compete. And more importantly for our listeners, it unlocks a mountain of upfront cash for Hartford.
Which leads us directly to the punchline of the quarter, the capital cannon.
Yes.
With the proceeds from the Wellington deal and the massive cash flow from their commercial underwriting, Hartford's board of directors just authorized a staggering $4.2 billion share repurchase program.
That represents a 27% increase over their previous authorization. It is a massive flex of financial strength.
I want to walk through the mechanics of a buyback because it can sometimes feel abstract to a retail investor. You know, a company issues a press release saying, we're buying back stock. The stock price might tick up a few percent that day, and then the investor forgets about it.
Sure.
But what does a $4.2 billion buyback actually mean for someone holding 100 shares of HIG in their retirement account?
It is structurally transformative over the long term. Let's look at the math. Hartford currently has a market capitalization, the total combined value of all its outstanding shares, of roughly $30 billion.
Okay.
If management executes this plan and buys back $4.2 billion worth of stock over the next 2 years, they are effectively repurchasing and retiring nearly 14% of the entire company.
They take those shares off the open market and literally delete them from existence.
They vanish. Now, apply that to the earnings. Let's assume Hartford generates $3 billion in total net profit next year. If there are 100 million shares in existence, the earnings per share, the EPS, is $30.
Simple division.
But if they buy back and delete 14 million of those shares, there are only 86 million shares remaining. That exact same $3 billion in profit is now divided by 86 million.
Right.
The earnings per share suddenly jumps to nearly $35, even though the actual business didn't make a single dollar more in profit.
The total size of the pie didn't change, but because they threw away 14% of the slices, your individual slice just got significantly thicker.
Perfect analogy. When you shrink the share count, you artificially inflate the EPS. And since stock prices generally track earnings per share over the long term, this buyback puts a massive solid floor under the stock price.
Beth Costello was highly specific about the pacing of this program, which I found fascinating. She stated they expect to increase their quarterly repurchases to $475 million every single quarter through the remainder of 2026.
In institutional finance, we call that a relentless bid.
A relentless bid. I like that.
No matter what the broader macroeconomic environment is doing, whether the market is panicking over a Federal Reserve rate hike, stressing over a geopolitical crisis, or selling off on a bad jobs report, Hartford's Treasury Department is stepping into the open market every single day and buying millions of dollars of their own stock.
For a retail investor, this creates a massive structural tailwind. It dampens volatility and exerts persistent upward pressure on the share price.
Absolutely.
During the Q&A, Alex Scott, an analyst from Barclays, pressed them on the funding for this. He wanted a breakdown of where this newly authorized cash was actually originating.
Right, and Beth clarified that approximately 15% of the new authorization is directly funded by the expected cash proceeds from the Wellington sale. But the remaining 12% increase comes purely from the organic capital generation of their core insurance businesses.
Which brings up a critical philosophical point about this management team. Another analyst, Elise Greenspan from Wells Fargo, asked Chris Swift point blank about mergers and acquisitions.
The M&A question.
Yeah. She essentially laid out the premise. You have monetized your asset management business. You have this massive war chest of capital. You are shrinking the share count. Does this signify that you have absolutely no intention of going out and acquiring another insurance company to fuel growth?
And Swift's response was absolute music to the ears of value investors who prioritize discipline over empire building.
He acknowledged that they monitor market activities, but he explicitly stated they are equally committed to an organic plan. He emphasized that organic growth is a safer way to grow and protect margins.
Because corporate acquisitions in the insurance space are notoriously fraught with peril.
Why is that?
You often overpay for the asset, You deal with massive culture clashes between underwriting teams. And worst of all, you inevitably find hidden skeletons.
Underpriced legacy liabilities.
Exactly. In the target company's reserve closet. The fact that Hartford's management is looking at their multi-billion-dollar war chest and concluding the highest return, lowest risk investment we can make right now is simply buying our own company demonstrates tremendous capital discipline.
They know their small commercial engine is a fortress. They know they can organically generate an 18.7% ROE. Why jeopardize that elite efficiency by attempting to integrate a lesser competitor at a premium valuation?
They are sticking to their core competency.
However, as we look ahead to 2027, the guidance wasn't entirely sunshine and buybacks. There was a subtle, highly nuanced moment in the Q&A regarding their future operational targets that we really need to highlight.
It was brought up by Katie, an analyst from Piper Sandler, who pressed Beth Costello on the company's 2027 expense ratio targets.
Right. As we discussed earlier, the expense ratio measures how much it costs the company to operate. Salaries, IT infrastructure, marketing, broker commissions, expressed as a percentage of their collected premiums.
Obviously, every company wants this number to trend downwards over time to demonstrate operational leverage and efficiency.
Beth confirmed that while the business insurance and employee benefits divisions are fully on track to hit their efficiency goals, hitting those targets in the personal insurance division is now a substantially higher bar.
A substantially higher bar. In the delicate language of CEO speak, that is a clear signal that they are probably not going to hit the target.
Yeah, that's management of expectations right there.
It is a deliberate, calculated downward management of expectations. She didn't throw in the towel. She praised the team's efforts. But she acknowledged the stark mathematical reality of their growth dynamics.
Right.
If your auto insurance premiums are shrinking by 10% because you are losing customers to competitors, you have significantly less top-line revenue.
But your fixed costs, your corporate servers, your customer service call centers, your baseline marketing budget, those don't shrink by 10% overnight. They stay flat.
Right. So if the revenue drops, the expense ratio mathematically has to inflate. It is a vicious cycle inherent to a shrinking business line.
So we now have the complete diagnostic picture on the table.
We do.
The commercial business is a cash printing machine with a massive technological moat. The investment portfolio is throwing off serious yield due to higher interest rates and smart alternative investments. They have some localized friction with lawyer-driven social inflation in their casualty lines, but they are currently offsetting it with massive profits in workers' comp. The personal lines business is shrinking to protect margins and will likely miss its expense targets.
And to tie it all together, management is deploying a $4.2 billion capital cannon to aggressively buy back their own stock.
So, looking at this entire board, the commercial moat, the personal lines bleed, the legal risks, and the capital returns, how should a retail investor weigh the risk versus the reward? This brings us to the final segment of our deep dive.
The bottom line.
The talk ticker's verdict.
Based on the underlying data, the strategic positioning, and the valuation dynamics discussed on the call, Hartford Insurance Group presents as a highly compelling dividend and buyback supported hold, bordering on a cautious buy for new capital.
A hold bordering on a cautious buy. Let's build the framework for that thesis. Lay out the bull case first. Why do I want this stock in my portfolio?
The bull case rests on two distinct pillars, the engine and the shield.
Okay, the engine.
The engine is the small commercial business. It is an absolute fortress. They have built deep, incredibly sticky relationships with independent brokers, driven by a best-in-class technological portal that makes quoting policies instant and frictionless. They are generating a combined ratio in the mid-80s, which is elite top-tier profitability, while simultaneously growing the top line at 7%. That is a compounding wealth machine that is very difficult for competitors to replicate.
And the second pillar, the shield.
The shield is the $4.2 billion buyback program. Management has committed to returning a massive amount of capital directly to shareholders. That $475 million they are injecting into the open market every single quarter provides tremendous downside protection.
Even if the broader stock market experiences a macro-driven sell-off, Hartford has a built-in buyer relentlessly supporting the share price.
Exactly. When you pair a rapidly shrinking share count with an 18.7% operating ROE, You create a financial structure that mathematically resists significant downward pressure.
It is a defensive powerhouse paired with an aggressive compounding engine. It's a very attractive profile. But we have to look at the dark side of the thesis. What is the bear case? What is the scenario where a year from now, we're looking at the stock down 20%?
The bear case is tied entirely to the legal system. The social inflation in commercial auto and general liability is not a temporary blip. It is a structural societal shift.
Because juries are angry.
Juries are angry, and third-party litigation funding has provided plaintiffs' attorneys with unlimited resources to drag cases out and extract nuclear verdicts.
Hence the $46 million and $26 million reserve bumps we saw this quarter.
Management insists it is a modest adjustment. They insist their forward pricing models are capturing the trend. Given their historical discipline, they might be right. But
if we fast forward to the Q3 or Q4 earnings calls, and Hartford announces another round of adverse reserve development in those specific casualty lines,
so the narrative shatters. If that modest adjustment morphs into a chronic recurring trend, it signals that their actuarial models are fundamentally broken and lagging behind the reality of the courtroom.
It means the earnings they're reporting today are inflated, and they will be forced to continuously drain future profits to pay for older claims.
And if the institutional market sniffs out a chronic reserve deficiency, they will immediately assign a much lower price-to-earnings multiple to the stock, completely neutralizing the benefits of the share buyback program.
You also have to monitor the bleed in personal lines. If auto and home continue to contract at a 10% clip, that expense ratio is going to balloon, and it will inevitably start dragging down the overall company ROE.
That is a secondary concern, but a valid one. However, given the massive scale and profitability of the commercial business, the personal lines bleed is manageable as long as it remains a controlled descent and doesn't accelerate into a chaotic freefall.
The casualty reserves remain the true existential risk factor to monitor.
Absolutely.
So boil all of this down to actionable advice for the retail investor listening right now.
If you already own HIG in your portfolio, hold your position. Sit back, collect your quarterly dividends, and enjoy the persistent structural tailwind of that $4.2 billion buyback and the 18.7% ROE. Do not prematurely sell a compounding machine that is actively and aggressively shrinking its share count.
And if you are looking to deploy new capital and start a position,
if you are looking to buy, you can proceed with confidence that you are purchasing a top-tier commercial underwriter operating at the absolute top of its game. But you must enter the trade with your eyes wide open.
Accepting the reality that their consumer-facing personal lines are actively shrinking to survive.
Yes, and you must rigorously monitor their casualty reserves in the upcoming quarters for any signs of chronic, lawyer-driven pain.
That is exactly the kind of nuanced, actionable breakdown we aim for. So to wrap up our analysis, the Hartford is an incredibly profitable, capital-generating machine navigating a complex environment. They are choosing the disciplined path returning capital through buybacks rather than chasing risky, ego-driven acquisitions and letting their dominant commercial underwriting and high-yielding investment float drive the compounding.
Well said.
But before we sign off, we always like to leave you, the listener, with a final provocative thought, something to mull over while you're driving to work or walking the dog. A thread to pull on that builds on the data we've discussed today, but looks a little further over the horizon.
The thread that fascinates me connects the two most dominant themes of this entire earnings call.
Which are?
Hartford's massive investment in technology and their ongoing battle against social inflation and plaintiffs' attorneys. Throughout the Q&A, Hartford executives, specifically Mo, repeatedly mentioned that they are investing heavily in advanced AI use cases.
Right, not just for underwriting, but specifically for claims processing.
Exactly. He declined to disclose the specific financial metrics or key performance indicators, but he made it clear the investments are substantial.
We discussed how they use AI and analytics to instantly quote a small business policy. They use it for speed and efficiency.
But I want you to think bigger. As we see attorney representation and third-party litigation funding continuously driving up the cost of commercial claims, the insurance industry is essentially locked in an arms race against the plaintiff's bar.
Right now, the lawyers have the upper hand. They're using data, analytics, and massive pools of hedge fund capital to pinpoint exactly which jurisdictions yield the highest jury awards and which settlement tactics extract the most cash.
So what happens when the massive insurance carriers finally decide to fight fire with fire?
Oh, wow.
What if the speed and data crunching power of advanced artificial intelligence becomes the ultimate weapon insurers deploy to neutralize social inflation in the courtroom?
Imagine a proprietary AI model built by Hartford that can instantly analyze millions of past casualty claims across the entire industry.
An algorithm that can identify the exact behavioral patterns and settlement thresholds of specific plaintiffs' attorneys.
So instead of a human claims adjuster sitting at a desk feeling the pressure and getting bullied by an aggressive billboard lawyer threatening a trial,
it is a cold, emotionless algorithm playing three-dimensional chess with the settlement negotiations. The AI could predict jury outcomes in specific counties with chilling accuracy, calculate the exact moment a litigation funder will want to cash out, and automatically adjust settlement offers in real time to starve the law firms of their massive margins.
the plaintiffs' attorneys have successfully weaponized the legal system against the insurers over the last decade. But over the next 5 years, the insurers might just use their massive capital base to weaponize AI against the attorneys.
If a company like Hartford can successfully transition AI from a simple underwriting efficiency tool into a tactical defense system against social inflation, it completely rewrites the risk profile of the entire casualty insurance business.
That murky, probabilistic reality we talked about at the beginning of the show, AI might finally be the tool that clears the water. It is a technological arms race, and it is something to watch very, very closely in the quarters to come.
It's going to be fascinating.
Thank you for joining us for this Talk Ticker's deep dive into the Hartford Insurance Group. Stay informed, stay curious, and we will catch you on the next one.